Well, hello everyone, all the attendees. My name is Daniel, and I am on the Vancouver Startup Week team. Thank you for joining us today for VSW 2020, and welcome to Deconstructing Consumers and Cash, hosted by Canada Startup. Before we begin, I'd like to remind you that once you leave this session, please immediately refresh your browser. Hopin will not show you any new events or updates or live sessions unless you refresh your browser. Heading out to reception will not refresh your Hopin. Please manually refresh your browser to make sure you do the steps so you don't miss out. I want to draw your attention to the chat room on the right-hand side. Please use that chat to post comments. We will also be using the chat room for Q&A at the end of the session. Please make sure that you're using this session's chat room and not the general one where messages get sent to everyone. I'd also like to invite you to check out the expo area afterwards to visit Canada Startup's booth if you want to learn more or would like to continue the conversation with them. I'll now pass the mic over to Chris and Colin, and we'll begin the session.
Thank you.
Thanks so much, Daniel. And thanks everybody for joining us today. We're just going to get things underway. Hopin is a new platform for Colin and myself, so a bit of a practice here. Colin, you let me know once we've gotten to full screen on the presentation, and then we can get things underway. How does it look?
I think it looks good, Chris. I mean, I think we can get going.
Okay, sounds great. So I'm doing full screen share. Does that show up for everybody?
Yeah, we're getting yeses, Chris.
Fantastic. Okay, that sounds awesome. Well, look, thanks again for all of you attending our session today. It's great to be here, and we want to start things off by recognizing that this is a fairly lengthy 2-hour presentation, and we know you all have very busy schedules. So for you to set aside the time really means a lot for us. We're going to do our absolute best to make this a power-packed, valuable session for you. Also want to thank all the organizers of the VSW 2020 Organizing Committee for inviting us to be part of the program this week. We know there's a lot of great presenters, so to be included in such fine company is a great thing for us. So thanks again. My name is Chris Stairs. I'm a senior consultant with Canada Startup, and I'm happy to introduce Colin McWhinnie, the founder of Canada Startup, who's going to be co-presenting with me today.
Hi, everybody.
Thanks so much, Colin. For those of you who've not met us in the market, Colin and I have been working together now for actually going on about 10 years this fall, working as a team, providing sales, marketing, and money modeling support for both early stage startups here in Vancouver, as well as for those later stage companies looking to scale. That's our background. And what we're presenting on today is a presentation, Deconstructing Customers and Cash, that we've actually presented and evolved over the last 3 years. This presentation, you're going to actually be seeing the latest iteration of that today, and it stems ultimately from some critical learnings and critical discoveries that we have experienced with the many different startups we've worked with across any number of industries, from physical device, software as a service, e-commerce, consumer plays, in helping our clients really get their head wrapped around money modeling and around their go-to-market strategy. This program, we think, for those of you online, we think this program is going to be especially valuable for any of you who are going through the process for the very first time as an early stage startup, trying to get your head wrapped around your money model. You may be crafting your first ever pro forma, or for that matter, even a second stage pro forma for another raise of money. Or alternatively, any of you who are struggling and having a difficult time really understanding what it takes to build and to budget out a proper sales engine to help you achieve those first few revenue goals as an early stage startup. I think you're going to find this content is extremely helpful for you. Now, the one other apology we're going to share with you all is it is a jam-packed session. Colin and I are actually going to be demonstrating a bit of a system or methodology that we really advocate all early stage startups to apply to their own business situation. In order for us to get through this entire presentation front to back, it is going to take closer to the full 2 hours. So we're hoping to leave about 5 or 10 minutes for some early Q&A. But reminders, first off, this session is being recorded. So we certainly encourage you for any of those sections where we may be running a little quickly, please do feel free to go back and watch the video a second or third time. Also, Colin and I, immediately after this presentation, will be hosting a trade booth in the expo room, and we'll be there from 3:30 to 4:30 to answer any further questions. And then, of course, we certainly encourage you to send us an email. We'll have our contact information available again at the end of this presentation, and we'd love to hear about your own situation and try to help you determine how to apply what we're going to share with you today to your particular business model. So that sort of sets us up. But what we'd like to do now, just to lay out the groundwork for what we're going to get into today, we're going to set the stage, and we're going to explain to you how we came about really evolving this entire presentation. And we're going to lay out for you a bit of a problem premise that we've identified in the 10 years that we have been advising startups in the market. And here's what typically happens for a lot of early stage entrepreneurs. There is some fantastic best practices and a lot of excellent support in the market delivered by many of the better accelerators in town that helps early stage entrepreneurs understand what it takes when you're struck with an idea or an inspiration and you're convinced you have an innovation that really is going to fit a particular market challenge. There's a standard practice and a process that helps you transition from idea to market validation. And we often refer to it as your market validation training and market validation procedure. And it's a pretty straightforward step-by-step process that requires you to properly kind of flesh out and really try to enunciate the problem product thesis that you're looking to address. What truly is that market challenge? Usually it involves you taking it and modeling it against the business model canvas published by Strategizer. Always, 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 we advocate early stage entrepreneurs, before you even begin to develop a prototype, you want to go through some customer discovery, talk to the real human beings that you suspect are going to pay good money for your solution, and make sure you're on the right track. Validate your instincts about what the opportunity you think you've identified. From there, you're fleshing out your prototype, you're finding pilot partners to trial, and all of that then leads you towards your market entry plan. Now, usually, many of you would be well served if you actually attended one of the venture acceleration programs in the province, all sponsored by Innovate BC. And there's a lot of great accelerators in town and across the province who offer this program, including SFU Venture Labs, NVBC, Foresight here in Vancouver, Accelerate Okanagan up in the valley, and Innovation Island over in Nanaimo is just examples. If you haven't done that and you're in the early days, something you would certainly benefit from attending. Again, here is an image of the business model canvas, which again is a great way for you to begin to assemble all of the different variables, all the different pieces around the market and industry you're trying to penetrate, all the different components that it takes to really start fleshing out your business model and building a company structure around your concept. And last but not least, there's the standard entrepreneur's library that we certainly advocate you take some time to hunt down and read. These 4 books are sort of seminal works. They're not the be-all, end-all, but they're a great starting place, and collectively they represent about 1,200 pages of excellent of knowledge and guidance. Those are, without a doubt, when you're struck with inspiration, without a doubt, those are your essential sort of first steps to transition from ideation into validation and market readiness. But there is a challenge, and this is where Colin and I, after working in the market for any number of years, realized there's a bit of a shortfall. And the fact of the matter is that none of this addresses what is absolutely critical to any startup or any business at any stage in its growth, and it's a focus on the numbers. In actual fact, if you go back even to these 4 seminal works, what's a little bit alarming is there's a total of about 1,200 pages of content across those 4 works, and yet less than 5% of those pages are dedicated to sort of an in-depth understanding of how you need to model your numbers as a startup. And Colin and I started to run into this challenge more and more often. We would work with many entrepreneurs and early stage startups, and there'd be a lot of enthusiasm around even all the right things as it relates to customer discovery, transitioning into a minimum viable product, finding those early stage pilot partners to begin to flesh out your assumptions. And yet the two most common reasons for failure for any startup are either a lack of cash and running out of cash before you hit liftoff, or not being able to find enough customers to keep your business afloat, which is really all about lack of financing and a lack of financial literacy when it relates to reaching out and pitching investors, or a lack of sales acumen and just understanding how to build your sales engine. And this is really a bit of a challenge because, again, all business, no matter whether you're a startup or later stage, the universal language for business is about numbers and dollars. And the reality is that when you are first beginning to validate your notions around an innovation and your product problem fit in the market, at the very same time and right from the beginning, it's our belief, and we strongly advocate, that you should be thinking about your financial viability as well. You should very quickly start to think about what would be my pricing model and my price points in order to engage this market. What would the total potential deal value of a single customer look like over time? What are my cost structures? What's my profit potential? These are some examples of questions that you should be investigating right from the start. And again, you're not going to have all the data points in the beginning to make a precise model out of this. We're not necessarily saying you're jumping into your pro forma right away and breaking out a spreadsheet, but it is certainly something that you begin to rough out and develop just sort of an intuitive understanding of where you could be going with all this.
Thanks, Chris. So yeah, just to give a bit of a background where we got to this as well is, what we were finding is that we were being either hired by companies to come in and help them with their sales and marketing, or we were hired by investors actually to go in and help them do some due diligence on some of the sales stories that they were getting from some potential investments that they were looking at. So we would go into these companies and really start out with what we thought were pretty softball questions, actually. What is your sales goal? How are you going to get there? Trying to get them to explain how they came up with the sales goal. Where did you come up with your marketing and sales budget? So let's just say, actually, we were taken aback a little bit by the lack of detail in a lot of the answers that we were getting back, and really very much the lack of confidence in how a lot of these founders were delivering it, actually. So that's where Chris and I actually started to focus on this, because again, as Chris said, we found that there was a bit of a lack of information and guidance as far as getting founders to really understand the underlying numbers, especially around their sales and marketing process. And what it's about ultimately is what we're going to talk about in today's program, which is how do you deconstruct that and actually do it in a very simple way so you can combine your financial model with your sales model, and each of those numbers can interplay with one another. And as one of the previous slides said, we like to actually call this hard skills. There's a lot of soft skill stuff out there, but when it comes down to numbers and understanding the underlying numbers of your business, we like to get into hard skills and really getting founders comfortable with that.
Thanks for that, Colin. Absolutely. And that's a big part of what we're going to dive into today, again, is just helping you to begin to get comfortable and understand how to be nimble and bounce back and forth between your financial model, or what I often just refer to as your money model, and then understanding your sales model and how to build out a sales engine that helps you accomplish your financial goals and to make that money model real. Now, there's a couple of caveats, again, we're going to share with you today. First off, we are going to walk you through, here's the good news, a bit of a step-by-step systematic process. You're going to walk away ultimately with a checklist of exactly how step 1, step 2, step 3, you can begin to just rough out your understandings and get comfortable with your money model. We often refer to it as your cocktail napkin numbers. Long before you break out the spreadsheet and start really diving into a detailed, 5-year or 7-year pro forma, whatever the need may be, part of our message is, look, don't worry about that level of complexity yet. Just begin with a rough estimation on the back of the envelope. Now, having said that, we are going to be moving through this very quickly. And so what we are actually going to be demonstrating with you today is exactly that. How do you just rough this out and begin with some broader assumptions? The second point that we're going to make is really the best way for us to illustrate precisely how the system works is by using a case model. And so today we're going to introduce you to a hypothetical company called Construct SaaS. It's a transactional SaaS company. By transactional, we mean, let's pretend we've got a software company that sells a construction management platform to the construction industry. But transactional means that it retails at a fairly significant price point. It's a complicated product, which means you're reliant on a sales team and human beings ultimately to navigate and close those deals. Unlike, say, for example, something like HubSpot or MailChimp, which is what we typically call a self-service SaaS, which is just, throw your credit card down like a retail transaction and primarily driven by a marketing engine. So we're just going to use that as an example. Now, many of you may not be associated with the SaaS, and you may wonder, well, I don't know if I want to be learning about a software company or the business model behind a software company today. Don't worry about that. We're just using this as an example. But the process we're going to share with you is universal regardless of what industry you're in, what your business is, whether you're selling a product or service. So we'll be learning more about Construct SaaS as we get underway. So now it's time to get started. Again, you've got strong instincts about an innovation that you can take to market. You're quite convinced there's a big opportunity here. Your customer discovery has validated that. But now you need to really understand, how do I make money with this thing? Where do I start? And what we're going to tell you is that the best way to do this is to step back for a second and say, look, there's 5 essential steps that you want to walk through to give yourself an understanding of what the critical numbers are behind both your financial model and your sales model. And I'll quickly run through them now, but we're going to break these down precisely as we get through the course of our presentation this afternoon. And those 5 steps are, first off, your unit economics of sale. And this is a term that especially early stage investors are very keen about. Do you understand precisely how much profit you are making off a single transaction with a single lifetime value of a customer? That is absolutely the most essential building block for your entire money model, and will help you to determine if you're getting profitable. We're then going to transition and spend some time understanding what your cost structure might look like, and in particular, your fixed cost structure. That burn rate, month after month, that you're pushing through, that is the absolute minimum cost you need to recover in order to survive. Once you have those 2 pieces, you're very quickly going to transition into what we often refer to as your minimum viable sales plan. Like, as your first step in exercise in terms of modeling out your whole business, what does it take to just break even, which is kind of that initial threshold of survival. But then after that, of course, that's not the end game, and it's certainly not what investors want to talk about. Then you get into the question of, well, how do I actually model out my first 5-year trajectory? Nobody has a crystal ball. It can be incredibly intimidating for you, especially if it's your first time, to try to figure out, how do I even understand what could be happening to me in year 3, year 4, year 5? Where do I pick those numbers? Well, there's a logic to it and a process that we're going to demonstrate. And then last but not least, all of that is ultimately going to inform your cash requirements and help you to understand exactly how much money you may need to raise and what you're going to be spending that money towards. That's the overall process. But before you even get into those 5 steps, it really all begins with understanding the overall journey of you as a startup through your first 5 years of growth, and understanding what those critical milestones are and how you should be targeting for your first set of precise goals. And at this point, I'll hand it back over to Colin.
Thanks, Chris. Yeah, and what we're suggesting is it all starts with setting precise goals. Now, that could be a revenue goal. It could be reaching a specific number of customers by a certain period of time. It could be securing your first 5 pilot customers in the first year, for instance. But it's really important that you set that goal, because as Steve Blank says in his book, build and they will come is not a strategy, it's a prayer. So it's time to aim at a goal and figure out what it's going to take to achieve it. So we're using Mount Everest as a bit of a pictorial here, but ultimately, again, this slide represents a real goal. Now, getting to the summit of Everest, that's great. What we find is some founders will throw caution to the wind here, grab a backpack and maybe a Sherpa and begin their ascent with gusto. But without the proper planning and resources, I think we all know how that probably is going to end up. So there's other founders who take the more sedentary approach and hope the summit comes to them, but that's probably not going to happen either. So what we're recommending is you need to take a more calculated approach here. You need to break the goal into stages. Those are key milestones that you can set. Each one of them will get you closer to the ultimate goal.
And again, look, this is a bit of a cliched example, but the reality is it serves as an excellent illustration for what we're trying to propose, because just as a mountaineer has a series of camps that they need to push through in order to reach the summit, it's exactly the same with an early stage startup. And we're really kind of focusing on those first 5 years of growth from the point of launch. The reality is, and this is universal for any startup, it does not matter what industry you're in, what you're selling, product or service, hard physical device or a digital software, there is a standard roadmap that you need to lay out for yourself. And it assumes that once you've got that minimum viable product to a point where you believe you can commercialize it and launch a sales program, then really this is about understanding what are those first 4 or 5 critical milestones. And typically they go as follows. The very first milestone in green there is even confirming that you actually have a repeatable sales model. And in some instances, it takes a bit of time to actually confirm that you have a proper set of tactics that's going to enable you to close clients time after time. But after that, it gets into the really essential milestones, which are first and foremost, when are you, how much business do you need to generate to break even? And how much business do you need to generate in order to be cash flow positive? And the reason why we've separated those two is because quite often they don't actually occur at the same time. Recording a profit on paper, more often than not, when you actually model it out using a pro forma and when you launch and you get into the real world, you'll discover that from accounting perspective, you can actually record a profit quite often firsthand. But because your business in the very beginning is very cash intensive, usually you're spending an incredible amount of money to drive a marketing and sales engine, or if you're in the manufacturing business, you're usually spending a lot of cash up front to build up an inventory in order to begin selling. Well, the reality is, because that's so cash intensive, especially in those situations where you've got capital development issues, then you may not actually hit positive cash until a little bit after positive earnings. But here's the message. Without a doubt, as an early stage startup, from a financial perspective, those are going to be your absolutely first 2 essential milestones to achieve. Then after that, you're really talking about, well, wait, how do I set a growth rate? And a lot of people assume and try to strive towards the infamous hockey stick. And the reality is that very rarely happens for most early stage startups. And the unicorn, as we always like to talk about it, truly is a rare breed. And so in actual fact, what you typically want to do is model out something that's much more realistic, much more feasible and achievable, and a bit more gradual in progression. And it usually starts by making a decision about a bit more of a linear growth rate. And what we often refer to as unitized growth, which we will get into in our example. And then only later on do you really want to start thinking about what a more aggressive, accelerated growth model would look like through scaling and finding strategies that enable you to achieve exponential revenue rates. But that's it. Those 4 milestones are very much like setting up those 4 camps on the way up to the summit of Mount Everest. And you need to be keeping those in mind as you build out your financial plan.
And it really allows the founder to set the tone for the team too. You lead with purpose. When you establish precise targets and time frames and you give them numbers, it makes people feel more comfortable. In our experience, they don't necessarily like operating in the gray if they don't need to. And ultimately for the founders, they can understand the milestones that they need to survive and be successful. So from the investor's perspective as well, as Chris just said, you know, they don't necessarily need to see a hockey stick right away. What they're very impressed with often, though, is that when you're explaining your business model, you're using sound logic. There are some sound economics behind it. You understand your fundamentals, and ultimately, you've got a repeatable sales opportunity where it makes sense. You've proven it out, and ultimately, you understand the numbers behind it. And ultimately, again, what the team really appreciates, if you're a sales VP, somebody that works in the marketing department, somebody that actually works as a sales rep, for instance, these precise targets are foundational. Ultimately, it feeds the sales process and pipeline metrics. You're looking for lead gen targets. You're looking ultimately for the size of team that you need to carry that out, how much you need to spend, and ultimately, again, what are some of the key benchmarks and KPIs that you need to set for the team to make sure that you're on track, stay on track, and reach those goals.
And this may seem really straightforward, but the reality is we've experienced it. We've seen it time and again, and we've lived it. Colin and I have both been directly involved in startups, and it's actually a very daunting task to pick that precise number and put the stick in the sand and get comfortable with that number and secure buy-in from senior management through to the sales team, your board, and your investors. Everything we're speaking to in the abstract sounds like common sense, but we can tell you that emotionally, the moment a founder is required to pick that first goal, it becomes a totally different ball game. It becomes real, because once you put the number on paper, you're committed to that number. It introduces a degree of accountability, and we recognize that can be very daunting. But again, what we're trying to bring to you today is to say, look, the reality is there is a bit of a straightforward process, and there's a system you can follow, and it's highly defensible, both to your team and to the investor, because it's rooted in common sense. And so the first place we encourage you to start with, again, is that first critical milestone. Once you know you've got a bit of a sales engine that truly is repeatable, you've got a team and resources in place that are helping you to sell time and again, and Colin's going to get into a little bit more of what that looks like. The question then is, well, what is my first goal? Well, look, you know, let's not beat around the bush. Let's just stick with break even. It's a really straightforward target. You can estimate that target using a pro forma without having any sales information. It's a known quantity, and it is your do or die threshold, break even, and then pushing into cash flow positive, because the moment you reach that threshold is the moment, as both Mike Volker and Ralph Turfus, two very well-respected and seasoned serial entrepreneurs in town and angel investors, will tell you, as entrepreneurs, the moment you are cash flow positive is the moment you can have a proper, decent night's sleep. You know you're going to be able to handle the payroll for your staff. And it's the point at which you're no longer dependent on external funding. You can take a pause and reevaluate your strategic plan and your growth trajectory. So we always say, look, start with break even and think about what it takes to use that to calibrate your money model. Back to you, Colin.
And ultimately, if I'm a VP of sales or a chief revenue officer, what I need to answer are some very specific things for me and my team. So what does that mean around the volume of sales that's expected to reach that, for instance, and the revenue targets? And then I need to work backwards. How many leads do I need to generate? What size of team is required to do that? How much budget do I have? What's the overhead and monthly burn that we need to deal with ultimately? And what's the timing of this? Are we looking at doing this in a year? Are we looking at doing this in 2 years? All of that's really important for me as the lead salesperson to understand ultimately how to put a plan together.
Together, we refer these often as your runway economics. And Colin raised a really interesting point, which I think you're going to find as we get into the specific case study with Construct SaaS today. Colin and I are going to role play a little bit as if a CFO and a chief revenue officer are having a dialogue back and forth about setting that goal. Is it a realistic goal? What are the resources I need in place as a sales and marketing team? How is that going to impact my overall operating budget? So we're going to start now really understanding the process behind that. We understand the goal. The first goal in this case, we're going to just peg the sand and say it's break even. What is the process? And again, we're now going back to these 5 essential steps, and we're going to start off with the first step, which is the unit economics of sale, the basis for repeatable profit. And again, look, this is not going to be an accounting lesson today. And we're going to stick with real simple math, and that's the point of the exercise. Keep it really simple, really intuitive, but you've got to make sure you go through these steps. And the first one is to say, look, do you understand precisely how much gross profit you're making off either a single transaction or off the lifetime value of an extended customer account? And again, it varies. If you're in a one and done situation, let's say you're selling refrigerators, right? You're selling a refrigerator, the odds of that customer coming back to you for 7, 8, 10 years are pretty slim. So your gross profit is pretty straightforward. It's the price of the refrigerator, less direct costs of sales and service. In the world of software, however, in the case of Construct SaaS, or for example, if you're in the marketplace model space, if you're modeling a marketplace, it gets a bit trickier because really what you're trying to do is figure out the lifetime value of a customer, where you know there could be recurring transactions with a single account. What's the lifetime value of a customer? And what are the customer acquisition costs to acquire and then retain that customer? But ultimately, it's very straightforward math. You're trying to figure out the average deal value, the recurring lifespan and lifetime value of that customer, and you're taking away the direct cost of sale or direct cost of service. That ultimately is going to help you to identify your gross margin on a single transaction. Now, again, that all seems pretty straightforward, but for Colin and myself, working with startups and modeling things out, it's really interesting because the moment we get an idea of the gross margin of a company and what they're projecting for, that serves as a distant early warning for us immediately. That's the first critical metric that we look at and that investors will look at, because we can tell you that depending on the kind of business you're in, there's a minimum threshold that you need to achieve. Now, our general experience is that if you run your numbers and you find that your gross margin, whether it's on a single transaction or whether it's the lifetime value of a customer over time, if your gross margin is between 75 to 100%, you're in a very strong position. Now, this is only one variable in your money model and in your sales model, but it's a really essential one in terms of the foundation of your profit. 75 to 100%, you're in a great position. But the reality is that for many device manufacturers, anyone selling a physical product, if you're in the software space or even just regular retail, you've got to make sure that your gross margin is averaging somewhere between 50 to 75%, or we can tell you already that you're probably going to be running into a little bit of trouble because you're not generating enough contribution margin over time and volume or enough net cash to cover your fixed costs of operation and ultimately to self-fund your growth. Now, there are some businesses that can get away with a bit of a lower gross margin. If you're in the service sector, like a consultancy, you've got relatively little overhead. And we've certainly seen successful companies that have a gross margin of closer to 30 or 40%. But the reality is, if your gross margins are going lower and lower and lower on that table, and certainly if you're getting below 25% on a typical gross margin, well, the message is basically you're either probably going to get into trouble very quickly because you're not generating enough cash and enough gross profit, or you better be in a situation where you're generating high volume and very quickly in order to get you into a self-sustaining position. So what they call low margin, high volume sales. But that's a pretty rare beast when you get right down to it in the early days. Let's start to really contextualize all this for you. We've been kind of laying down a lot of theory, but now's where the rubber hits the road, and we're going to get into some specifics. We're going to talk about Construct SaaS. Again, they're a SaaS company. So the moment Colin and I would sit down with a software company and they told us what they were getting into, we would ask immediately, what are the unit economics of a single sale? And we'd be looking for a number between 50 and 75%. In the case of Construct SaaS, what we're going to say is that they actually already have about 10 anchor clients that they've been supporting for the last year, year and a half. Those clients on average have been generating about $25,000 in annual recurring revenue. These clients are quite big. We're talking about a team of 100 individuals who are licensing the software every month at about $29.95 a month. So annual recurring revenue is about $25,000. They've discovered over the course of sort of onboarding these first 10 clients that they're dealing with about a 3-month sales cycle. And they're conservatively estimating that at the very least, these clients, once they're with them, are going to be with them for a minimum 2 years. Now, the reality is in this particular space, this particular model, they're more than likely to be sticking around for 3 or 4 years because the switching costs, once you invest in this kind of platform, are actually quite high. It's a bit painful for a construction company to suddenly switch out to another platform. But let's be conservative. You always typically want to do that in the very beginning when you're roughing out your money model. We're going to say at 2 years, then the lifetime value is $50,000. So then remember, we're looking though for the gross margin and the gross profit. Well, with software as a service, it's a bit tricky because there aren't really truly a lot of direct costs to sale. Once you build software, it's out there in the cloud, and you're just trying to sell the thing over and over and over to amortize your development costs over time. There may be a few direct costs. There may be some transactional fees at the beginning. You may be able to peg a certain percentage of your server capacity against each individual customer. There could be upwards of 10% in commission. But that's not really truly capturing all of the costs to acquire a client. And the challenge in the early days, one of the many conundrums that early stage entrepreneurs have, especially in the software space, is they're getting asked by investors for a CAC, a customer acquisition cost, as an average metric, but it's too early to tell because they don't have enough data points. So in this kind of a situation, this is when you typically want to do a little bit of research in the market, and you want to start researching what are industry benchmarks. And in the case of software as a service, it doesn't take you long with a bit of a Google search to identify that the most successful software companies in North America have learned that if their customer acquisition cost exceeds 35% of the total lifetime value of a client, they're going to get into trouble. And it's going to start getting very difficult for them to sustain the model. Now, every industry, if you look for it, every industry has these kind of benchmarks. If you look at other companies that are a few steps ahead of you or even well established in the market, it takes a little bit, but you can typically find these benchmarks. So in the case of Construct SaaS, we're saying, well, look, we know the LTV is 50,000. So what that's telling us early on is that if it's upwards of 35% is an acceptable threshold for customer acquisition, the most I should be paying to acquire this client, conservatively speaking, is about $17,500 in total sales, marketing, and service spend. And that's leaving me $32,500 or roughly a 65% gross margin. And no big surprise, that metric falls exactly within the sweet spot of 50 to 75% as your typical gross margin for a SaaS company. So that is your first essential metric in terms of getting comfortable with your money model and starting to understand how you look at your numbers. If that first goal is break even, a couple of the key pieces are understanding the average deal value in a year at 25,000, and also understanding what would be the total allowable customer acquisition cost. We now move on to the next step, which is stepping back and saying, if I understand the amount of profit that I'm targeting to make off a single transaction in a year, what is my core operating budget in a year? And again, today, this is not meant to be an accounting class. We're going to move through this very quickly, but all of you should, over time, as your team grows, as your operations grow, you need to be tracking exactly what you're spending on a month-to-month and year-by-year, product development, operations fulfillment, your finance, general and administration, your executive office. You need to get your head wrapped around that and really start to zero in on precisely what that number looks like as a fixed cost per month and per year, because that is the absolute minimum that you need to recover in order to reach that do or die threshold of break even and ultimately cash flow positive. Let's go back to our case study, Construct SaaS. We're going to say, hypothetically, that Construct SaaS is spending roughly $725,000 on these core operations year over year. And trust me when I say there's actually a 5-year pro forma behind all of these numbers. I've actually gone to the lengths of fully modeling out a software company in the construction management space and developed a 5-year pro forma and drawn numbers from that pro forma to illustrate this point. And these numbers ultimately are coming from actual clients that we've worked with of one kind or another. The metrics are very simple to very similar to what we've seen working with real clients. Now, unfortunately, there's a bit of a challenge here. We know the core operating costs up to date in terms of your development team, your administrative team, and your executive office are running you at about $725,000. But what most startups at this particular point in time in their growth and evolution as a company, what they have not done is actually budgeted and built out for the first time a comprehensive and repeatable sales and marketing engine. And so that's the other piece of the break-even formula that they need to estimate. But it's a bit of a challenge because Colin, as the Chief Revenue Officer, is going to tell you, well, I can't really give you a sales and marketing budget if I don't have a goal in order to model that budget towards. But in this particular case, the goal is break even, and you can't figure out what break even is until you know your sales and marketing budget. It's a bit of a chicken and an egg exercise, and everybody goes through it. And we've gone through it with multiple clients. And we get to a point where we say, look, don't worry about it. Again, we're doing this in the rough. This is a back of the envelope estimation. You've not gone to a pro forma yet, and you're certainly not putting this in front of an investor. You're just trying to get a rough notion of where this could go. Well, if in doubt, we're going to tell you that the majority of startups we've worked with, and it's a kind of a funny law of nature, a real safe place to start if you're trying to peg a sales and marketing budget is to take whatever you've been spending on operations and take that same amount and assume immediately that's the minimum you're spending on sales and marketing. And it is not unheard of in terms of your total liftoff budget, which we're now going to just roughly peg at 1.45 million. It is not uncommon when you get to that break-even estimation that at least 50% of your overall budget is going to be sales and marketing. And we've seen it as high as 85% in some instances. And this is a bit of a eureka moment for a lot of entrepreneurs and founders, especially entrepreneurs and founders with a strong background in engineering and software development and have been spending a lot of their time in the trenches of product development, but maybe not as much experience around building out a sales and marketing team. This is actually a bit of a surprise for many, but it reflects reality. And certainly in the case of Construct SaaS, we're going to tell you this is roughly in the ballpark. We're going to round things up to 1.5 million for the purpose of our example to keep the math simple, but we're going to estimate, and again, this is just your cocktail napkin numbers, that it could be quite possible for a transactional SaaS to need to achieve about 1.5 million in annual recurring revenue in order to reach that break-even threshold. And the reality is this is actually about the norm for a lot of software companies we work with and for the industry. So again, we've identified that we've got a break-even budget of about 1.5 million in revenue, but we've got to take this one step further. And Colin, as the Chief Revenue Officer, is going to understand, well, what does that actually translate into a practical sales goal? The funny thing is that sales reps don't focus as much on the revenue target. They focus on the effort to get to that revenue target. And with Construct SaaS, first off, we're going to identify that the break-even target is 1.5 million. A reminder, we're going to say we already have 10 clients at about $25,000 in annual recurring revenue, already generating revenue for you, $250,000, which means your net new business target is about $1.25 million. Well, what we really need to identify is how many new customers, how many new deals do we actually need to achieve? Because that's how we really start to build a sales engine around the effort. And in this particular case, again, if we know that we need to generate 1.25 million in net new recurring revenue, and we know the average deal value is going to approximate about 25,000, then we think roughly it's going to require us to land an additional 50 new customers on top of the 10 existing clients in order to get to that goal of 1.5 million. And
this is where, as the senior sales person, this is where the numbers all start to make sense to me, because that number I could do something with.
And I would then turn to Colin and I would say, Colin, look, that boils down to one deal a week. Does that sound like an attainable target for you? And this is, again, where that conversation back and forth between the financial planner, or the CFO, if you will, and the senior sales team is going to be beginning that very real rubber hits the road dialogue. Now, there's a couple of other what I call check your head moments that you want to take at this particular point in time. We've now fixated on a number that Colin has recognized and identified with, and hopefully starting to get comfortable with, 50 deals. But now we want to kind of say, wait a minute, all of this was predicated on the fact that we kind of picked a number out of the hat as it relates to the sales and marketing budget of 725,000. But Chris, look, I don't believe you that every single startup, is going to be spending 50% of their total liftoff budget on sales and marketing. Well, now we can actually do a bit of a work back and find another way to hone in on that number and see if it makes sense. Remember, we estimated our customer acquisition cost per client. The allowable amount that we should be spending on a customer is about 17,500. Well, we think and are estimating, and it's not going to be perfect. It could end up being, 52, 53, or 48, but we're like, geez, I think we're probably talking about 50 new deals, 50 new customers. We had estimated a budget of 725,000. Well, 50 times 17,500 allowable CAC is getting you to about 875,000 as an acceptable sort of benchmark-driven sales and marketing budget. So in actual fact, we may be justified in considering a sales and marketing budget that's even higher than 725,000. Now, having said that, there's definitely some discrepancy here. There's some swing room of about 150,000. But don't worry, we're going to come back. We're going to continue to refine and test this number and make sure that's an acceptable and a logical number that is defensible as a sales and marketing budget, both in the eyes of Colin as the Chief Revenue Officer and also in the eyes of your board and your investors. So that's your first check your head moment. The second check your head moment, now that we're starting to get into some real numbers that we're roughing out on our cocktail napkin, is we're going to say, well, wait a minute, what does this look like relative to our TAM Samsung? Usually going all the way back to that market validation training program that you took with your local accelerator is they're going to tell you, hey, you've got this wonderful innovation. That's great. But what is your total addressable market? And what ultimately is your immediately attainable market? Well, that's a great number to see. It usually ends up being a really big number, but it's a very abstract number. You need to get to a point where you can contextualize that number and make it something that's useful for you. Well, now you can do that because now your first target needs to be 50 new customers. What does that look like relative to the size of your immediately addressable market? Well, in this case, we're going to say that Construct SaaS wants to sell into the North American market, and we've done some research, and we know there's at least 6,500 leading contractors in both Canada and the US, and as many as 27,000 total contractors when you add in small and mid-sized construction operations. And there's about 7 million construction workers who've got to be tracked and managed through some form of construction management software. So as a percentage, you can then now go back to that addressable market and say, well, actually, okay, what that's saying is that I need to land less than 1% of leading contractors and less than 0.2% of my total addressable market in order just to achieve break even. Now, you're going to need to step back for a sec. Each industry, each market is going to be a little bit different. You're going to ask yourself, is that an acceptable and attainable target? I think in the world of SaaS and construction management, I would be sitting down with Colin, finance guy and sales guy, and saying, yeah, like that percentage is a comfortable percentage. It's, you know, it's not ringing any alarm bells. But this is a check your head moment that each of you wants to go through when you get to this stage in the exploration of your money model. So now we're wrapping up step 2 of the 5-step process of really kind of just getting comfortable with your numbers and building out that money model. We have a simplified goal. Our first goal, to achieve break even, we need to generate 1.25 million in net new revenue, and that represents 50 new customers with a lifetime value of only 2 years, a very conservative estimate of only 2 years, representing a total of 50,000 in LTV. But how do you now build a sales engine around that? How do you get it done? It's great to have the goal, but the tricky part is really understanding what it takes to build a sales engine that's consistent, predictable, and that's going to drive you towards profitability. And this is where we start getting into asking those more difficult questions. We've got those first few questions that Colin alluded to before. Colin, as the Chief Revenue Officer, now understands the volume of sales he needs to achieve for this first milestone and the revenue target, but how many leads do we need to generate? How big a team is this going to require? What kind of resources are going to be needed? And really, we're now, you know, we've been estimating 725,000 as a possible sales and marketing spend, but really we've got to tighten up that number and understand what it truly looks like. And here's where I, as the Chief Financial Officer, would be handing it over to Colin as our Senior Sales Strategist to start to walk through the minimum viable sales plan to get there.
Thanks, CFO. So we now kick into what we call the minimum viable sales plan. I've now got a goal of 50 sales that I need to get to. And what we've developed with clients over the last few years to help them get through this is what we're calling the sales primer. And it's a systematic method. And basically what it helps companies do is design the marketing and sales process required, taking a look at that and then breaking down the numbers at each stage of that process, then even going deeper and understanding the effort that's required at each stage, which ultimately gets to the size and the type of marketing and sales team that you need to hire to be able to achieve it. And ultimately, at the end of the day, that gets you to a sales and marketing budget that's required. So let's revisit our Construct SaaS company. They know that they need to achieve 50 sales. So that's really, at the end of the day, confirming that goal. And that's where we're at right now. So how do we take that and ultimately start breaking down the sales process and the pipeline required actually to get those 50 sales? So what we're looking at next basically is a visual of the sales pipeline. So many of you have probably done some version of this. You know, there's no shortage of different sales pipelines or sales processes. And the interesting thing is they vary depending on the type of business. If you're a B2C, would be very different from what it would be for a B2B. If you've got a simple solution, you might have less steps in the sales process to where a more in-depth solution, a more enterprise solution might require more sales steps to accomplish the sale. So what we're using for Construct SaaS here is a pretty typical sales process. It starts at the marketing end where you need to generate impressions and traffic and leads for the sales team, ultimately that needs to qualify those leads more, needs to generate high quality sales opportunities for the senior salesperson who ultimately would be doing a proposal, negotiating and closing the deals, and then ultimately throwing it over to service to ultimately onboard and provide support for those clients. So that's where we're at with this. This is the example that we're going to use with Construct SaaS. So ultimately, many companies get here, but this is where we start seeing a lot of companies fall short, actually, which is really estimating the pipeline metrics at each of those stages. This is what's really going to start getting you into the type of numbers that you need to understand and the underlying numbers below your sales and marketing process. So right now, what we've done here is just look at some metrics, and what these conversion metrics are what it takes at each stage to get a lead or a prospect through to the next stage. And what we like doing here is actually backcasting this. But just to explain and give you an example, at a 3-to-1 conversion ratio, what we're saying here is that for every deal that you need to make, Construct SaaS sales team needs to be dealing with 3 sales opportunities. So they close 1 out of 3 of those. As another example, for sales qualified leads, you need to actually get 5 sales qualified leads to be able to generate 1 sales opportunity. So as you can see, the metrics actually follow through here. And for Construct SaaS, probably what they've done, because they've got a little sales experience at this point, hopefully what they did was to be able to track what it took to get those 10 existing sales. And maybe what they did was use some benchmarks, some industry benchmarks as well, to come up with those kinds of conversion percentages. So this is where the magic starts. Ultimately, you can go back to that slide, Chris. What really happens here is there's our 50 deals. And what you can do using these metrics is, again, instead of forecasting, we like calling it backcasting. And so with the 3-to-1 conversion ratio, ultimately what they're going to need is 150 sales opportunities to be able to actually generate those 50 deals. At a 5-to-1 conversion ratio of sales qualified leads to opportunities, they're going to need 750 of those, and so on and so forth. So what you're really doing is starting to get an understanding of the kind of volume based on the metrics that's required throughout the marketing and sales process. Now, the next step here is, now that you've got that, is quantifying the sales effort. And ultimately, again, what we've seen here is we've got 60 customers to service, 50 deals, 150 quotes, and 750 sales qualified leads that we need. We're just using the term exchanges here basically because it requires ultimately a lot of effort potentially to qualify those leads and make sure that they're high quality leads to put them into the sales opportunity bucket. So now what we want to do is take a look at, well, what's the effort required at each of these stages by a human being to do each of these tasks? So what we're estimating, for instance, to qualify a sales lead, in this case, Construct SaaS actually says that it takes about 4 hours, and that might include doing a sales demo. It might include a little back and forth, basically sending the prospect information. It could actually include talking to multiple decision makers and just making sure that that lead is well qualified to make sure that they are a good sales opportunity. For at the quote stage, it's estimated that it takes about an hour to put a proposal together and ultimately get it to the prospect. And at the deal stage, they're estimating that it takes about 3 hours, and that probably requires going over the proposal, potentially multiple conversations with the decision makers, and some negotiation. So what you can start doing now with those kinds of numbers is really figure out ultimately, if that's the case, and for instance, qualifying a sales lead takes 4 hours and we need 750 of those, again, pretty simple math, but pretty important to do. At that stage, we need 3,000 hours. And as you're going through this, again, if a sales opportunity takes an hour and there's 150 required, we need 150 hours at that stage. 150 hours at the deal stage. And ultimately, what's starting to actually creep up on us is, as the customers are starting to be closed and become clients, that service requirements actually getting a little big now too. So ultimately, what we can do here now is estimate our total hours required for the sales and marketing process. Again, what we've seen is 3,000 hours at the sales qualified lead. Quotes are 150. The deal close is going to be 150, and client fulfillment or service is 960. So we need a total now of 4,260 to actually close, and always getting back to being able to close and service those 50 deals. That's the target. So the next question we get asked all the time, and Construct SaaS is asking themselves this too, is, great, so who do we need to hire? How many people do we need to hire? And what's that going to cost? And ultimately, where the sales primer can take you now is taking a look at determining the team size and ultimately the type of people that you need to hire. Again, total hours are 4,260 that we've calculated, and what we've done here is a calculation. I've gone to my accountant and said, so how many hours per year does a typical rep work here? So we're just using available hours per sales rep of 1,320 is for the calculation, which is 48 weeks at 5 days. And we figure they're actually working on this process for about 5.5 hours a day. So what does that tell us? Well, that tells us if you divide that into the total hours, ultimately we need 3.25 reps. And that starts thinking about, okay, well, if we need 3.25 reps, and going back to the pipeline, we're actually required to generate quite a few actually impressions and leads to generate those opportunities. We might need to hire a marketing coordinator at this point, and ultimately a business development manager to manage the whole process. But what this slide shows nicely is that if you look at the process, it starts to give you an idea of the type of people ultimately that are required along this process. And whether it's a marketer from a lead gen point of view, an SDR, a sales development rep that's really in charge of qualifying leads that are coming through the pipeline, a senior sales rep that would be traditionally doing the sales opportunities and closing, or a service rep, which is ultimately dealing with clients after they become customers, matching that with the volume of hours that's required at each of these stages starts getting you a very good idea ultimately of the type of hires that you need. So in this case, again, for Construct SaaS, it works out to they're going to need at the qualification SDR stage 2.25 reps to handle that volume based on the effort required. At this point, they only need 1/4 of a sales specialist to close the deals because the volume is not that great based on the effort required. But ultimately, again, what probably happens in a typical startup is that the owner, for instance, looking at that, or the founder might continue doing the sales. We have a lot of clients at this point to where the client or the owner will continue doing the sales until a point to where either they get really big or it just the volume actually becomes viable to the point of hiring a full-time sales rep. Need 3/4 of a service rep. So again, you need to cover it. And from a founder's point of view, do we hire somebody early and take the hit on the budget because we need to actually have somebody there and they can work into the job and work into the volume? Or ultimately, can somebody else handle it up until this point, until we absolutely need it based on the client volume? And these are the discussions that go on all the time with
well, and Colin, I'll jump in with 2 other just role play scenarios to give our audience an idea. The wonderful thing about having numbers is the numbers start to trigger dialogue within the team and start to trigger ideas about how you would address the actual build of the sales engine. The service rep, for example, I mean, we know by the end of the year, closer to 3/4 of a service rep's capacity would be used up to onboard and train new clients. But there's a spare quarter that potentially you could put towards, if you hired somebody full time to really be effective with onboarding, you're going to probably want to start producing some video tutorials about the software product. You may start to realize you need to author a very comprehensive Q&A document, frequently asked questions. Well, that takes time. And so the service rep is spending 3/4 of their time actually working with the customers. But you may decide to make a strategic decision and say, we're going to hire somebody full time, because when they're not with the customers, they're building out training materials to help the customers. Similarly, with the sales specialist, the decision might be, look, we know eventually we need more than 2 SDRs. We don't quite need a sales specialist yet. But on the other hand, what you might do is hire 2 SDRs, but with the understanding that one of those SDRs may eventually transition into a full-time sales role, and then you backfill with the second SDR. So there's a number of different ways you can peel the onion, but you can't have any of these kind of conversations without just kind of looking at this numerically first and understanding quantifiably how the growth model is going to shake out over time, and how your hires are probably going to need to occur.
And what's great about this is, we usually put this up on a whiteboard, and if we invite actually the founder at some point to invite the team in, and when these numbers are very visual and right in front of everybody, a lot of things actually become very real. And there was one discussion we had where it really defended the sales rep, because ultimately, very early startup, and that person was being asked to do the sales qualification and closing the sales. And when the numbers came up and he was being asked how much effort he was putting into closing the sales, it was very minimal. The founder was very shocked at that, because there was enterprise sales, which you would think he would be spending a little bit more time doing the proposals and communicating with the senior people from the potential clients. And it just became very apparent that because there was so much volume required at the qualification stage, he just couldn't do it. And immediately the founder got on the phone and hired an outbound service to do qualification for them, because it became obvious, actually. And that's the beauty of this visual, ultimately, is that it not only gives you a really good understanding of the underlying numbers, but it really prompts some excellent discussion within a team, not just on what could we be doing, but when you put historical numbers up on this thing too, it can give you a real insight into maybe where you're falling, and why you might not be reaching goal as well. So really good stuff. Just a quick thing, Chris, we're getting some questions on chat. Will the slides be available? I believe they will be. And ultimately, again, the sales primer, that worksheet, we'll make available for everybody at the end of the session and tell you how to get it. So we'll make sure we circle back to that.
And again, as we mentioned, for any of you who may have showed up a few minutes into the presentation, this is also being recorded. So you'll be able to come back to this a second and third time if you want to review any of the other content. Something else I'm going to say, and then we'll jump into budget. Colin raised a really good point, and we've actually had that eureka moment with a number of our clients over the years, where you start putting the real numbers up there, and it becomes a bit of an empowering conversation with the sales team, because quite often you can be working side by side with somebody and not actually fully appreciate how much they're doing and where they're spending their time. And sometimes, especially if it's a junior member on the team, they don't necessarily feel like they have permission to have this conversation. Well, we actually, just as one example, we did this exercise with one other company just in the last 12 months, and it was a bit more of an established company. And they had a strategy they were trying to pursue where they were trying to cultivate channel partnerships and work with resellers as well as direct selling at the same time. And we went through the exact same exercise and the exact same process. And what ultimately came out in this meeting with the entire team was there was one poor individual who was required both to qualify leads for direct sales, but also completely coach and engage channel partners and build out a channel partnership program at exactly the same time. And when we started to put hours of effort to it, we immediately identified, well, you need to have a channel specialist. You need to have a manager dedicated to channel partnership development. And I believe, Colin, within about 2 weeks, that report was taken to the board and a budget was approved for a separate channel manager.
Yeah.
And again, I think we'll step back for a sec for all of you on the line. It's funny because when Colin and I walk through all of these numbers, as we've just done now, the mathematics are very simple. I mean, my 12-year-old daughter can do this without any difficulty at all. The irony is we found time and again in the 10 years that we worked with our clients that as simple as this exercise looks like, it doesn't actually get done. Instead, people remain in the world of abstracted generalities without actually just going this one step further and applying the numbers. And we think part of the reason why is because we think people are a little bit intimidated by the numbers, because certainly with numbers comes accountability. But actually, we feel it's the flip side. With numbers and clarity around quantifying your effort, you actually become empowered to make better, far more strategic and far more informed decisions. And that's ultimately the root philosophy behind everything we're talking to you today, is the sooner you embrace the numbers and the sooner you begin quantifying the whole effort in even the simplest of fashion on the back of the envelope, the more informed and the more educated you can be about your strategic decisions. So let's just jump into this. Is the fifth and final part as it relates to the minimum viable sales plan and ultimately how you use the sales primer methodology. Well, now again, remember, we can now circle back and really start to get much more detailed and much more confident about what a likely sales and marketing budget is going to look like to achieve this liftoff break-even budget of 1.5 million and to achieve those 50 net new customers. We had originally thought that, as a starting point, that this could be a $725,000 sales and marketing budget. Well, now, after going through the process that Colin has just shared with you, we can be much more precise about the different elements and components of the marketing program, starting with our headcount. And we're just ballparking salary ranges based on what is probably likely here in the Vancouver market. For any of you who are not in BC or Vancouver, the specific numbers may look different, but I think you're going to recognize the value of the exercise. First off, we now have a bit of a sales and marketing team we're building out with a manager, digital marketer, 2 SDRs, at some point a sales specialist, an account manager, or call it a service rep, plus commission and bonus. Well, all of that is going to add up very quickly to, I think, a little over $500,000. Then you need to look at all of the money you've got to put into the actual lead generation side of your engine. And we're just estimating for ad spend between digital and print in this particular market. We did a little bit of research in terms of cost of impression and cost of marketing qualified lead acquisition. We're kind of saying, based on all the metrics that Colin shared earlier, upstream in that pipeline, in terms of 37,500 in traffic, so forth and so on, that you're probably looking at an ad spend of 125 to 150,000, or roughly 10,000 a month. In this particular space, you're likely to hit at least a couple of trade shows, and those trade shows, to do it right, are costing you somewhere between $20,000 and $30,000. You're going to have other program elements that you need to develop in terms of collateral, website, training videos, and so forth and so on. All of that is going to add up to a figure of about plus or minus $825,000. And if you need a second digital marketer, and if you find out you need to add even more to your ad spend, what's interesting now is you can see how this is all circling back to that original CAC benchmark that we set up of 875,000, and we're starting to get into the ballpark. So again, just a moment of pause. Remember, the whole point of going through this exercise, and we haven't even gotten to a pro forma yet, put aside the spreadsheet. We're trying to get to our numbers, and we're trying to get to those numbers from a few different directions. And what we've ultimately done is we've started to really hone in on what we think is a precise sales and marketing budget from 3 different directions. We started by saying, well, let's just take the ops budget and double it. Then we started to get an idea of what the total number of customers would be, and we used the CAC benchmark. Then we used the sales primer, and we thoroughly deconstructed the sales engine because we now had a target of 50 customers. And now we're coming up with a very precise sales and marketing budget, all of which is kind of tightening up to a range of somewhere between $800,000 and $850,000. And these are that you have now gotten to a point where you have highly defensible numbers based on logical assumptions that you can present to your sales team. Your sales team is going to have buy-in as it relates to the sales volume, revenue target, the leads you need to generate, the size and structure of the team, and the minimum spend. This is information you can take and discuss internally with your team, with your board and your advisors, and most importantly, with your investors. And just to give you assurance, we've presented this methodology with investors in the room, and we've had investors come to us and say, if only the companies that pitch and present to us were to present their sales and marketing engine in precisely this way. And in fact, just to give you an idea, that one client that was struggling with their channel partner program and spreading their workforce too thin, the reason why we even got into a discussion with that client was because one of their investors saw us present deconstructing customers and cash and said, I would really love for you to speak to one of my companies because I think they show incredible promise, but I think they need to put a little bit more structure and rigor around their sales engine. Can you help us? And so it gives you a bit of an idea about how all this works. Colin, I'll hand you back over to sum up the sales primer and our findings here.
Yeah, I mean, the previous slide, again, these were the questions that I needed to answer, right? I mean, from that 50 sales, I needed to understand and try to break down what it was going to take to get those. And going through that process with the sales primer allowed me to do that. I've got, and again, they're estimates. But it's a really, really strong starting point. And ultimately, knowing this now, I'm a happy camper because I know that I've got a very defined target of 50 deals. I've got a very defined 750 sales qualified lead target from 3,700 or 3,750 inquiries. That actually allows me to properly communicate to the sales team and the marketing team ultimately what's expected of them. And that leads to a whole bunch of very good things as well, because one of the big challenges founders have is trying to figure out the right sales compensation, the right numbers to put to that. And this really helps you get on its way and really helps you explain again, the rationale behind the sales goals and the marketing goals that you're actually setting for them, which is incredibly important because far too often we walk into companies and one of the things we do is we call it a sales audit. And, we'll ask a sales rep about their sales goal and ultimately how it was explained to them. Was there a rationale given? Was there a really strong plan set to actually where they understand very clearly how to achieve that? And unfortunately, often enough, they give us a blank look back. So this really gets you on the road to actually being able to be specific. We know how many hours of effort is required, and that translates into not just the number of people that need to be hired, but the type of people that need to be hired, which if you're a recruiter is a really, really important piece of information because the kind of talent that you're looking for instance, for a good sales qualifier can be very different from a good sales rep. So, senior sales reps like to close deals. They don't necessarily like to be on the phone qualifying them. So you just have to be realistic here and really figure out the kind of talent that you need. And at the end of the day, you know what kind of budget you have to work with. So this is a really strong start for me as the senior salesperson.
And again, presenting this gives incredible confidence to the investor that you have a well thought out plan, because eventually this is going to lead to an understanding of your cash requirements. And ultimately, you're going to have an ask. You're going to be sitting down in front of investors saying, I need a certain amount of money. and this is what I need to use it for. And when it's presented in this fashion, both a properly defined goal and a milestone that you're attempting to achieve, and you've done the backcast effort through your entire sales engine, investors are going to they're going to understand this. There's logic. The assumptions are defensible. The other thing it's going to do for you is bear in mind, these are the kind of numbers that both your marketing team and your sales team can drive towards. Because what's a classic challenge with most companies is there's quite often, frequently, a disconnect and lack of communication and lack of alignment between the marketing and lead gen function and the sales function. But when you walk through the sales primer and you backcast all the way through the pipeline, as we've done, and you set those targets stage by stage, then the marketer has as much of an understanding and has very precise goals that they're targeting for, as well as the sales rep. And it becomes one sort of integrated machine. Now, granted, once you get out into the real world, you're going to be testing some of these metrics and you're going to find some of these numbers may change. But as a team, you're now using the primer and that pipeline, and you're monitoring all of the critical metrics to ensure that those numbers are aligned, or to have that discussion about where things may be off from what you assumed and how do you pivot and reset your expectations. So last but not least, just closing out this section, we talked about the runway economics. Now we can circle back to our original estimate about the total liftoff budget, and rather than 725,000 $825,000 for the sales and marketing budget, we're now at 825,000, which is about another $100,000 that we're budgeting for. So it looks like our liftoff budget is closer to 1.55 million. Again, you're just estimating this, right? Like the growth of your company is a continuous organic process. All you're trying to do is get a ballpark understanding of where that's going to occur. Now, the reality is you've probably introduced now another, technically you probably need 52 customers rather than 50 new customers to break even. It's not so important whether you get down to that precise number. It's more about roughing out the numbers as a ballpark on that cocktail napkin.
And I think it's really important, again, people sometimes when we're presenting this get caught up on the numbers, the metrics that we put in, the conversion percentages, etc. We've actually tried to make this as realistic as possible based on our experience and research and so on and so forth. But it is a hypothetical. It really just is to showcase ultimately how the system can work. And it's in rough. And even when you do it for your own company, it's really meant to be a start. But ultimately what we find, you could even do this before launching your company, but before, if you're trying to figure out whether your company is going to make money or not, and ultimately what it's going to take to do that, you could do this at the very beginning. As well, for a company that might be more mature, we've sat down and ran through this with a 10-year-old, 20-year-old company, because ultimately they haven't necessarily done this, and it really is an eye-opener. But at the end of the day, it's an estimate, but because you put thought into this as a startup, you can sound very logical when you're talking about your ask, and the numbers that you're going to be presenting are very defensible. And the other thing actually that we find with founders is that they love this because it gives them, not just defensible, but for their board as well. When they have that monthly board meeting and need to walk in to explain what's going on, the more that they understand the underlying numbers using this, the more that they can explain why they are on target, off target, what else they need to get on target, etc. And they can have a much more intelligent discussion around this. So yeah, we're getting some great feedback about this, but ultimately, again, you got to work with the numbers, you got to test them, and ultimately they will change.
Really great points, Colin. And the other item I'll bring up as we get into part 4, which is understanding how to build out your 5-year trajectory now. Because again, we've just been, what we've done with this process is it requires every startup to sit down and systematically make certain they understand how the financials of their company work. And are they poised to make a profit? So this step-by-step process, I mean, it requires you to ask rudimentary questions like, are we consistently making the same amount of profit for every single sale and off every single customer? Have we actually even sat back and thought about, well, what's the maximum amount of money I want to spend to acquire a customer? Like, do I even know what that stat looks like? And if I have a rough idea of what that looks like for me, how does that match up against what a more successful SaaS is currently achieving out there? You know, have I even set a very specific quantifiable growth target? And then certainly once you get into the complexities of the sales pipeline, has anyone actually sat back and thought about, well, how many leads do I need to start generating at the beginning of the year in order to get to 50 deals at the end of the year, which requires you to go through that conversion dialogue that Colin ran us through with the pipeline, really understanding the conversion ratio and backcasting all of those numbers. So we hope we've kind of presented it in a relatively simple and straightforward fashion. But if you step away for a minute, I think you may find that in many cases, the process in and of itself, if it's taken in this step-by-step fashion, ultimately helps guide and instruct a startup to understand where and how to evaluate their numbers. But at this point now, we're going to move on to the 4th step, which is really understanding, well, okay, this is great. You know, I understand the unit economics. I've taken some time to really understand my fixed cost structure and my burn, and I now have a sense of what a liftoff budget looks like in order to achieve break even. Colin is very helpfully walked us through what it takes for you to think about that essential sales plan to get you to that first target. But of course, there's a point at which you as the founder need to switch gears and say, okay, well, this is certainly more than just reaching break even and cash flow positive. I mean, that's not the end game for my company. And it's certainly not what investors want to see at the end of the day. I need to begin thinking about what my 5-year trajectory is going to look like. And that gets into the exercise of building out a 5-year pro forma. And again, that's a bit of a daunting task for those of you who haven't done this before. But this is where we encourage you now to circle back to that roadmap, that roadmap of milestones, and start to think about, okay, we've got a sense of these rudimentary numbers and these foundational economics to our business. How do I actually precisely lay them out over a 5-year horizon using a pro forma? Well, again, let's go back to break even. And the first question we kind of want to ask ourselves, because there's been an assumption the whole time, the first question we want to ask ourselves, well, how many years is this actually going to take just to achieve break even? Colin and I, up until now, have sort of been assuming, well, let's shoot for a 12-month time frame. Can that be done? But let's go back to Construct SaaS and let's look at that first stretch of the 5-year trajectory. And again, we were saying, well, 50 deals over 52 weeks is sort of 1 deal a week. Does that make sense? But again, this is where you want to step back for a second and say, well, yeah, but there's going to be a ramp up here, right? Like, because we remember that the sales cycle to close a deal takes about 3 months. And as you just start out, I mean, you're only just starting to fuel that pipeline with leads. And it's going to take a little bit of time to start qualifying that leads and get to a point where you're closing those first few deals. That's probably a minimum 3-month time frame. Plus, a sales and marketing team need to get trained up. It's typically a minimum 3 months for your SDRs and your sales reps to truly get comfortable with their product knowledge and understand how to address objections and really properly script out a customer discovery phone call. So then the question you're kind of asking yourself is, well, you know, should I be modeling out something where I'm kind of assuming I lose the first 12 weeks in terms of sales development and customer discovery? Which gets into a dialogue now about modeling out more aggressive versus more moderate case scenarios, because quite often we get into that with our companies as they say, look, I have an investor who's asking me how do I model out a moderate versus an aggressive scenario? And what we typically tell people is that, look, modeling an aggressive versus a moderate versus a worst case scenario is not about changing the target number. It's about adjusting the time frame at which you're going to reach the milestone. And it's a fundamental difference, because usually what we do is we see people say, well, maybe the best case scenario, maybe my moderate is 50 customers, maybe a worst case is 40 customers, maybe a best case is 60 customers. But it's kind of like, well, that's relative to what? Is that considered a success or not? Instead, the target is still 50 customers, but the question is whether you're going to achieve that in 12 months, or whether you're going to be a little bit more conservative and say, given the 3-month ramp up, I think we should assume we hit those 50 customers in 15 months, or maybe a worst case scenario is it takes closer to 2 years to reach break even. And every company is going to be a little bit different. In the case of Construct SaaS, that's the discussion they're having right now. And it twins with the discussion about the amount of cash they're going to need to raise. And we'll get into that in part 5, is of course what happens is when you model this out in a pro forma, and most especially when you get to your cash flow tab, every pro forma has an income statement, but ultimately has a separate cash flow tab that helps you to track the money that's going in and money that's going out relative to your bank account. The assumptions you make about the timing of break even is going to have a direct impact on the length of your runway and how much money you need to raise. But this is all like, we're now transitioning from those back of the envelope calculations that we handled through steps 1 through 3, and starting to understand how we now transition those numbers into your pro forma. And what I'm going to suggest to you is we've got the bits and pieces now to help you model out years 1 and 2 on a 5-year pro forma. And I'm going to put to you that, a software company of this kind is really sort of striving to hit that break-even threshold by the 2nd year. We're going to say in the case of Construct SaaS, that'd be sort of a worst-case scenario. And as I mentioned to you, once you start modeling that out in a pro forma using a spreadsheet, your cash flow tab is very quickly going to help you to sort of identify when you hit cash flow positive. And our experience modeling out software companies is usually actually break even and cash flow positive happen almost at the same time. But we'll say conservatively there's a bit of a delay of, let's say, 2 to 3 months. Certainly the ones I've modeled out, that's often the case. But this is something where the pro forma, once you put the numbers into a spreadsheet, the pro forma is going to start to help you understand that. And again, depending on how things get modeled out, you're going to begin to get an understanding of how much money you need to raise. But that's only for the first, let's say, 2 years of your 5-year trajectory. So now you need to think about the next 3 years of a 5-year pro forma. And I'm using, by the way, a 5-year pro forma because that's typically the horizon that the average investor wants to look at. Now, depending on the startup you're involved in, sometimes, in the case of break even, if you're opening up a cafe or a restaurant, I'm going to tell you, you're hoping, and I would hope, you're getting to break even self-sustaining by the end of your 1st year. On the other hand, if you're Elon Musk and it's SpaceX, I just looked up the numbers. Well, he's 18 years into his operations. And while he's now making a profit off each individual launch service that he sells to a company that's trying to launch a satellite, like his unit economics are profitable, but he's 18 years into his operation and he still hasn't achieved break even, according to a good number of the analysts. So, again, this is all within context. But in the case of Construct SaaS, we're really now trying to understand, what does the 3rd and 4th year look like? And that's about switching gears and saying, well, how do I choose a growth rate that's logical? And what we typically say is, well, look, let's just start with a linear model. And let's sort of think about the unit of growth. It's always about, with money modeling, identifying units of metrics that you now understand. The first one is your unit economics of a single sale. You're targeting to get 65% in gross margin. Well, we now have a much larger unit of growth in terms of building out a repeatable sales engine. We've now identified, using Colin's sales primer system, that 50 deals, in theory, is going to cost you every year about $825,000 in budget. You need a team of about 6 personnel, a little over 4,000 hours of effort to generate those 750 sales qualified leads. Well, One scenario in year 3 would be to just simply say, what if we just hold steady? Like, what if we see if we can just do that a second time, which is perfectly respectable, because that would move you from 60 customers to 110 customers. That's nearly a doubling of business, which is nothing to sneeze at. That would certainly be a metric that I think would impress most early stage investors if you can pull that off by your 3rd year. Or you might say, well, you know what, I want to be a little bit more aggressive than that. If I know my unit economic for 50 deals, well then, what if we actually tried to double our effort by year 3? What if we actually doubled up our budget or got close to it? You're going to start to see some economies of scale, but what if we had closer to 1.3, 1.4 million in our annual marketing and sales spend in our 3rd year? What if we added another 3 or 4 personnel to our team by the 3rd year? And what if we were chasing 100 deals rather than 50 deals? Well, look, the reality is there's a few different variables going on, but this is up to you again to determine what a moderate versus a more aggressive growth scenario might look like. But our message here is start with the increments of growth you understand. You know now, or have estimated roughly what it takes to grow 50 new customers. So now the matter is, the simple matter of a growth rate is to simply say incrementally, what would it look like if it's 50 new customers in the next year, 100 new customers, or maybe something in between. You're also going to want to make sure you're modeling in a churn rate, of course. And I mean, you can research this online, but usually you're trying to drive your customer churn downwards to less than 2% a month in the world of SaaS. But those metrics are available for you to research, and you're going to want to build that into your model and begin to understand what that churn rate does for you over time. And again, of course, depending on the decision you make about how aggressive you're going to be with your growth model, that's going to have an impact on how much money you do need to raise over time. And the general rule is the more aggressive you want to be with your growth rate, if you've just achieved break even and cash flow positive, you are probably not generating enough cash out of your own operation to self-fund that growth rate. Which means if you're being really aggressive with your growth rate, you're going to need to be asking more money and finding more money through investment or debt financing. Now, that's as it relates to your decision about growth rate in years 3 and 4. But you also need to switch gears and think about your internal growth and managing your operations so that your capacity keeps up with the growth rate of your customer base. And this is where, of course, you're going to want to sit down with your ops team and say, well, look, this is kind of what we're looking to target in terms of our growth rate. What do we need to invest in terms of expanding our server capacities and our platform maintenance? What kind of a headcount do we need? We're putting more and more burden on the platform. How should we be expanding our operations team? And there's probably going to be product upgrades. Do we need another coder, another designer on board? Just to give you some a simple example of what the math might look like, even just with the service rep. Again, we've ran you through some numbers to tell you that a single customer requires about 16 hours of support on the part of a service rep. Well, again, if we assume a little over 13 hours a year in effort to support those clients, that means a single service rep is going to be able to handle maybe upwards of 80 clients. Well, again, depending on your growth rate, that's going to dictate when you need to bring on that next service rep. And all of this is what you're going to want to start to build and budget into your 5-year pro forma. If you're holding steady at a growth rate of just 50 new customers year over year, well, you may be able to put off the hiring of that service rep into, sort of halfway through your 2nd year, closing in on your 3rd year. If, on the other hand, you're being really aggressive with your growth rate, well, you're going to run the numbers and you're going to find out that you're going to hit that 82 client threshold much earlier in your growth rate, which means your pro forma now needs to reflect the hiring of a service rep much earlier on. Again, we're just giving you some examples of where you're taking sort of strategy and abstract understanding of what growth looks like, both internally and as it relates to your external growth model, and understanding now how to apply that against your pro forma. And that gets us through years 3 and 4. Just quickly now, we're going to jump into year 5, specifically for Construct SaaS. This is a hypothetical, But it may be around your 5th year, if you still have a year left to model, where you are now starting to think about, well, you know, what's the story behind scaling and achieving a more rapid rate of growth and really getting into some exponential numbers? Well, that's where you need to step back again and think about your goals and think about the milestones and understand what your story is as a startup. And it's usually around the 5th year. In the case of this software company, we're going to say that they might start thinking about, well, can I introduce a second product that can enable me to upsell my clients and expand the total lifetime value of my client? That could start to significantly accelerate my revenue from a client-by-client perspective. Could I be targeting other markets? Could I be going into another industry subsector? Or could I be transitioning from North America into Latin America or Europe or Asia? The big one is probably going to be channel partner strategy. How can I virtually expand my entire sales engine by partnering with resellers and channel partners in order to really start to drive aggressively into the market? These are the kind of stories you need to ask yourself first, like, am I going to be there in my 5th year, in order for you to justify putting down some more aggressive sales numbers. And then the same thing on the back end. If you start to present a story by your 5th year where you're really getting into scalable growth, well, you also need to start to introduce into your story solutions around automating your sales, service, and operations function. And you need to clearly think through what that might look like, because you're going to need to invest probably in certain solutions to get that done. And those investments need to show up in your 4th and 5th year of your pro forma, because an investor and an analyst are certainly going to look and say, hey, look, based on the scaling model you're presenting, this looks really good, this looks really bullish, but I'm not entirely confident that you're also keeping up your operational capacity at the same time to handle that volume of business. Walk me through the storyline, please. And again, we're just doing this in the rough, but this sort of gives you an idea. Once you've learned your fundamental economics and those fundamental financials behind just that break-even threshold, it gets you to start thinking logically about what your growth is going to start look like and how you model your growth in your 3rd, 4th, and 5th year. And that really helps to wrap up the 4th point, which is really sort of getting comfortable around projecting a 5-year trajectory. And understanding how it's not just making up numbers out of the blue, but it's recognizing there are milestones you're trying to achieve and finding ways to defend those milestones with a logical story and numbers. All of this leads to the last stage in the process, which is getting into cash requirements. We've gone through your unit economics. We've come to understand what your liftoff budget looks like and what it takes to build out a sales engine to achieve that. We've gotten in your 5-year trajectory. Eventually, as you model this out in a pro forma and you start looking at that cash flow tab, you're going to realize that you've got a net shortfall of cash for any number of years. It could be, in this case, hopefully 1 or 2 years, but it might even push into your 3rd year where you're still ultimately in a net cash position. And this is going to force you to ask yourself questions about how much money I need to raise and when I should be raising that money. Well, there's a few different ways you can look at this, but you sort of start off by saying, again, there's a roadmap here, and they're based on milestones. And more commonly, startups typically raise money in increments based on which stage they are in their development. First stage, again, is sort of achieving self-sustaining operations. That second stage is beginning to test out a more aggressive growth rate. That third stage, which is usually when you start getting in the Series A, Series B, is really starting to fund a much more aggressive, ambitious growth cycle that gets into exponential results. Now, sometimes in some instances, there may be an opportunity to aggressively raise a certain amount of money that actually gets you through multiple milestones. But I'm going to tell you, if you're early stage, that's pretty rare. Usually, if you are not at self-sustaining yet, if you're just building out a model to get to positive earnings and positive cash, more often than not, what's going to happen is that your investors are really going to want to kind of break things down and just look at the cash injection required to get you to that first milestone. There's an understanding that there will be additional raises, but it's really about focusing on that first milestone. There's another reason kind of why you want to do that, because every time you achieve a milestone, you have an opportunity to negotiate your next raise at a higher valuation level. And you want to do that because otherwise, going back to this slide, the faster you move and the more aggressive you are with your growth rate up front and the more money you ask for up front, the more likely it is you're going to dilute your ownership. Because you're ultimately going to be inviting somebody to inject a significant amount of cash that's going to dilute your ownership position. Whereas if you break up your raise in stages, and if you cross those milestone thresholds and achieve a higher and higher valuation, this is a bit of a strategy around investment and cash raise, but you're going to find that you're going to slow down the dilution of your ownership. And this is a different investment dialogue and a different strategy that we're more than happy to have a dialogue with you about. But you can't really get anywhere with this until you've developed your money model and until you've created that 5-year pro forma. Once you've done that, one of the things you can now do with that tool and with that understanding around your fundamentals is to begin to talk about your investor strategy and how many raises and how much you should raise. Just talking about Construct SaaS, because I know we're getting into our last 15 minutes, and thanks for all of you for holding out these last 2 hours. With Construct SaaS, again, we're going to take this exercise in bite-sized chunks. And Construct SaaS is really just focusing on the amount of money it needs over the next 2 years to achieve positive earnings and positive cash. And what we're going to do is just role play some examples of what may come out of that pro forma once you start looking at your cash flow tab and start playing with those different levers around growth assumptions. We're going to start by saying, well, in a moderate scenario, and that moderate scenario, again, would assume that you need a bit of a 3-month ramp up before you're really effectively selling, which means, you're targeting for a break even at closer to the 15 or 18 month time frame. And this is taking into account, of course, as you start to land clients, they're contributing revenue to your bottom line and your bank account. You're ultimately sort of saying, well, I'm thinking if I'm assuming an 18-month runway to cash flow positive and self-sustaining, I can tell you all online that if I were to present to you the pro forma, you're looking at a minimum cash raise of about $600,000 in order to get all of this done. On the other hand, that's shaving it pretty close. And one of the dialogues that you may have with your board and your advisors is to sit down and say, look, I don't know if that gives me a lot of wiggle room. And what if we actually looked at a scenario that landed somewhere more between moderate and worst case? And we certainly talked about that 3-month ramp up to get the sales program up and running. And we do recognize, of course, that gradually we are building a revenue base. But, let's just assume worst case scenario. It's actually closer to 24 months before we get the cash flow positive. And let's also introduce a bit of a buffer. One of the best practices for small to mid-size operations, and certainly for startups, where you can, is to try to always maintain a cash reserve of at least 2 to 3 months of your 30-day burn rate in the bank account. Like, in other words, if something went horribly wrong and you did not generate any additional sales, that you had roughly 2 to 3 months worth of cash in the bank to support your fixed costs and your payroll. That is absolutely a best practice that you try to target for. Now, the reality is many early stage startups, have a very difficult time actually achieving that. It's a benchmark you try to strive for, but nonetheless, what you would attempt to do is try to get there. And in order to achieve all of those thresholds, you'd really be looking at a raise of closer to $750,000 in order for you to comfortably fund the kind of sales engine that we're talking about and allow you as closer to 2 years to get to that cash flow positive threshold. And so that then helps you to not only to really plan out that 5-year trajectory, but to understand the cash requirements that are going to enable you to achieve those first 2 milestones of positive earning and positive cash.
Good job, Chris. I think it's important. We're just going to wind this down. And I think it's really important to remember all of this is a model, especially the sales primer. But it allows you to test the assumptions again. It's an incredibly valuable tool to test assumptions with your team, with the investors. And ultimately, again, just one scenario here that we'll take a look at. This is the original pipeline metrics for Construct SaaS. And if we just changed actually 2 of the variables here. So what we did was we changed the conversion ratio of opportunity to deals from 3-to-1 to 4-to-1. And we changed the sales qualified conversion rate ratio to opportunities from 5-to-1 to 6-to-1. Doesn't sound like a lot, but look at the impact that it has. All of a sudden, to still get those 50 deals, Chris, if you can stay on that slide for a sec, to get those 50 deals, ultimately, it went from 150 to 200 quotes and 750 exchanges or sales qualified leads to 1,200. And let's look at the impact of that on the next slide here. So ultimately, again, to hit the goal of 50 deals and 1.25 million in ARR, now you need 1,200 sales qualified leads. You need 6,000 inquiries as you kept on backcasting from sales to the marketing process and the leads required. Total hours of effort now are 6,100 approximately. And all of a sudden now the team that's required to achieve that's gone from 1 marketer to 2, from 2 SDRs to 4. You now have a full-time sales rep that's required, and definitely a full-time service rep as well. And your budget now has gone to 1.15 from the original 875 benchmark. I think the original budget for Construct SaaS was 825, Chris, if I
825, that's right.
Yeah. So, you know, just that in itself, when you're looking at setting metrics for your team and KPIs, just a little adjustment there and looking at the scenarios makes a huge difference in the numbers. So it's a great tool actually to take a look at the different scenarios and ultimately, again, are they, are the numbers that are required to hit the sales goal that you need within the budget that you think that you're going to have, are they realistic? Because if not, something needs to be adjusted.
And are they setting off any alarm bells? I mean, if we look at that bottom line, we are now looking at a budget that far exceeds what is considered sort of an industry allowable budget of $870,000 based on that earlier CAC benchmark. Now, we all know, look, an industry benchmark is not necessarily something you're going to accomplish as an early stage startup because there's certainly a learning process. So, maybe it's not unrealistic to be spending $1 million rather than $825,000 to get that initial engine up and running and test out all of your assumptions around your sales and marketing tactics and program. But in this particular instance, if it's taking you close to 1.2 million to achieve those 50 deals, probably that's signaling to you that there's something you need to work on and readjust and fix. And usually it goes, this is the value of the sales primers. It kind of goes back to the fact that a 4-in-1 deal close or a 6-in-1 sales qualified opportunity, it simply, to be frank, is not an acceptable close rate. You need to find a way to tighten up that sales process and do a better job perhaps in finding qualified leads, because it's simply not economically viable for you to operate and at that sustained level of performance. And again, just to wrap up, and I know we're closing out, thanks again, everybody. This is just from front to back an example of exactly how we encourage our clients and we encourage you as startup and founder to really bounce back and forth between your financial model and your sales model, understand the interplay between the two, and really get comfortable with your numbers. The sooner you begin investigating your numbers, the sooner you begin to get much more intelligent and informed about your strategy and what it is that it's going to take to get your company off the ground. Over to you, Colin.
Yeah, and again, from our experience, the more comfortable and confident you are with your numbers, the more confident you have in your investors. So ultimately, and your team, it just goes all the way down the line. The more that you can confidently explain this, understand it, and really it just becomes it's become second nature. That really conveys, gives a lot of confidence to people, either who you're team or to give you money. So, okay, so a few of you have asked on the chat here where to find us, so we'll just go over that, especially if you need some help. Again, we'll be in the chat room, or the expo, I guess they call it, right after this, if you've got some specific questions about what we presented there or about your company. The sales primer, which is really the process, again, of going through and breaking down your sales and marketing numbers from a goal, what we showed you today briefly. You can find it at www.salesprimer.ca, and from there you can enter in your info and download a PDF copy of the sales primer. So again, helps you with your goal setting, sales process, and effort. And we said, you know, what we've seen it help our clients with certainly is to make money, because they understand the underlying numbers required to do it. Helps them to raise money ultimately, because they can explain why they need the money and what they're spending it on. So pretty valuable tool. We'd love to hear your feedback actually upon using it. And again, once you start to use it, if you have any questions, here's where you can find us. We do consulting and execution here with our company, CanadaStartup.com. We are also advisors, actually. If you just want to talk to us for something very specific, for instance, and want to book an hour of our time, you can find us at Volition Advisors, where they're set up to be able to do that with both Chris and I. Chris is the finance dude, and I can talk to you about sales, ultimately. And that's it. Thanks very much. I think I'm looking at the clock, and it's 3:28. Well done, Chris.
It's action-packed, everybody. And look, thanks again for joining us. We really appreciate the 2 hours that you set aside. We know, again, it's a really tight and well-filled program with VSW 2020 this week. But for you to give us the 2 hours is greatly appreciated. And again, if you have any questions, we know we went through a lot and we didn't leave a lot of time for Q&A, but feel free to track us down, and hopefully you'll join us in the expo. We'd love to carry on the conversation and talk a little bit more about how all this might apply to your own situation. Daniel, thanks again for everything.